In this video, I'm gonna walk you through 9 different ways to invest your $10,000. Well, actually there are 10 ways, and I'm gonna backtest the returns, say if we travel back in time, invested 12 months ago and 24 months ago, and see who's the winner. Hi, my name is Irene. I create contents about investment, personal finance, and financial independence on my channel, so subscribe if you're interested in this kind of topics. Now, let's go. We always hear low risk, low return and high risk, high return, but why can't the stable investment generate higher return? Actually, that would be great, isn't it? Theoretically, the modern financial theory is based on 2 assumptions, and one of them is assuming the market is dominated by rational,
are you kidding me?
risk-averse investors. And what are risk-averse investors like? We expect actual rewards for any additional risks that we take. In reality, it generally follows the rule, and we can see this historical data going back to 1926 for US stocks and 1970 for bonds by Morningstar. The more volatile mid-cap growth stocks provide better returns than the large-cap growth stocks, for example. So today, the order of the 9 different ways to invest $10,000 will be following from the low risk to the higher risk spectrum. Number 1, saving account. I know we're living in a low interest rate environment. Actually, the overnight cash rate has been capped at 0.1% at Reserve Bank of Australia September meeting. And the highest interest rate offered by banks is about 1% on the higher side. And they normally have a couple of requirements, such as you're going to deposit $1,000 to $2,000 from the external account, and you're going to make a couple of transactions and or grow your balance from the month before. And some banks even offer a more attractive interest rate to a certain groups, normally the young people. And let's say we pick a bank that without any age restrictions, and currently ING offers 1.35% interest rate as long as you deposit a $1,000 to the saving account and make 5 settled transactions and grow your balance from the month before. Let's say we created an account with ING and transferred $10,000 to the saving account, and we meet all the criteria and we forget about it and let it grow. Actually, this saving account could be a perfect place to leave your emergency fund. By the way, if you haven't set it up, I strongly suggest that you set aside some cash that worth of 3 to 6 months of your living expense, and feel free to top it up to 1 year or 2 years if you want the actual margin of safety. How about bond? I can get the coupon interest and my principal back when it's due. Instead of buying a particular bond that normally expires 5 years plus, I decided to buy a bond ETF. Let's pick iShares Core Composite Bond ETF, ticker IAF. This ETF tracks Bloomberg Ausbond Composite 0+ years index. It's currently holding 530 bonds, and the management fee is 0.15%, and the 12-month trailing yield is about 1.63%. Hit the like button if you have bond in your portfolio, or if you don't have bond in your portfolio, still hit it. That will help my channel to be seen by more people, and I really appreciate it. Now let's move on to the next option. How about the stock index ETF? I like the idea of keeping my investment simple, low cost, and beat the majority of the actively managed funds. Let's invest in the most popular Aussie ETF, VAS, and this ETF tracks the top 300 of Australian companies by market cap. The management fee is 0.1%, and the dividend yield is about 2.66%. Or we can invest in the index ETF that tracks the S&P 500, which is considered the gauge of the US stock market. Let's invest iShares S&P 500 ETF, ticker IVV, on the 1st of September 2020. The management fee is about 0.04%, and the dividend yield is 1.09%. The fourth way is to invest in a real estate investment trust, and this is an indirect way to invest in real estate by not having to go out and buy property. And a REIT is a company that owns and operates real estate, and the shareholders will enjoy the income that's generated by the rent in the forms of dividends. And a REIT must pay at least 90% of their taxable income. So REIT is always considered a high dividend asset class. And historically, REIT has low correlation with asset classes, so that makes it an excellent portfolio diversifier. So instead of investing in a particular REIT, for example, BWP Trust, which is the landlord of Bunnings, an Australian household hardware chain, I decided to invest in a basket of REITs. So I pick Vanguard Australian Property Securities Index ETF, ticker VAP, and this ETF tracks S&P ASX 300 Australian REIT Index. Currently, it's holding 32 REITs in the fund, and the management fee is 0.23%, and the dividend yield is 3.66%. The next way is to use a couple of index funds to form a further diversified portfolio. I will use the lazy portfolio that I talk about in another video here. I put 3,000 in bond, 3,500 in global stock market, and 3,500 in Aussie stock market. So far, we have used the passive index fund to invest, and the next two options, we're going to use some active managed mutual funds, and which is the typical mutual funds form before the first index fund was invented by the legendary investor John Bogle in 1976. Every year, hundreds of fund managers around the globe try to build a superior portfolio to beat the market returns. In fact, 75% of active managed funds underperform the market in the US, and Australia has a similar result on a 5-year basis. But this could be an option for some investors, especially you are a fan of Cathie Wood. Speaking of Cathie Wood, her ARK funds have been the talk of Wall Street with phenomenal returns.
This trading around, this trading range, you as a trader and investor, but as a trader also, understand that when you build a base like that, one of two things is going to happen. It's either going to break down, and that's what a lot of the bears have been betting on, and they've been throwing everything at it, or it's going to break out. Clearly, we believe is going to break out. And the longer the base, you say 5 years, the longer the base, the bigger the breakout. So we're really looking forward to that.
One important point to have an actively managed fund is that we need to know the fund manager's investing strategy because our money is in their hands. For example, Cathie Wood, if she's saying she follows value investing and her funds are disruptive growth funds, but actually what she does is to follow a momentum investing strategy. We need to question that because if the momentum is fading, she would not be able to deliver what she delivered before. We actually could see the fact that when she sold out a lot of Chinese stocks in late July and bought back some Chinese stocks like Jingdu.com 1 month later, that is momentum investing. Also, the active mutual fund is less tax efficient than an index fund because the high turnover, the cost of buying and selling, the trigger of the capital gain tax is essentially eating the return of the fund and the investors are paying the bill. But never mind, let's invest in the ARKK and see what the 1 year return that it provided. Well, this option is particularly for Aussie investors, LICs, listed investment companies. And this option is actually very similar to invest in an active mutual fund, although with a couple of distinctions because LIC essentially is a company, it's not a trust, and LIC does pay franked dividends, which means that you don't have to pay your tax on the dividend or you only need to pay partial tax on the dividend. Well, I have produced a video comparing LICs and ETFs in general. Feel free to check it out after watching this one. Let's invest in Australia's largest and most popular LIC, Australian Foundation Investment Company, ticker AFI, and see what return it can provide us. Currently, the management fee is 0.14%, is a closed-ended active ETF. The next option is to invest in an individual stock. Well, compared to a much more diversified options that we talked about before, and this could be the most volatile option to invest. But I like Elon Musk's entrepreneurship, not only establishing one of the greatest EV company, but also SpaceX, Starlink, SolarCity, The Boring Company, and Neuralink. But let's invest in Tesla, this flying to the space stock back on the 1st of September 2020 and 2019. Next is to invest in commodity, which is normally used as a portfolio diversifier because of its low correlation with other asset classes. Redalio likes to use commodity in his portfolio. We can see the Bridgewater has 267 million value of physically backed gold ETF, GLD, which takes up 1.72% of their portfolio. And Redalio likes to use this asset class to hedge the portfolio, and we can see it from his all-weather portfolio where he used 7.5% diversified commodity and 7.5% gold. Let's invest in a physically backed gold ETF in Australia, ticker GOLD. Well, that was the 9 ways to invest $10,000. And the very last one I don't want to miss out is the cryptocurrency. The reason that I don't want to put up in the title 10 ways because I personally don't think it's a long-term investment. It's rather a speculative investment. For me, so don't get offended, crypto fans. But I don't want to miss out this option. So I wanted to pay Bitcoin to test but it was so pricey back in September last year. So it was out of our budget of $10,000. So I picked the second popular one, Ethereum, and see what the returns it will provide us. So I created an Excel sheet to see the 1-year return from the 1st of September 2020 to 1st of September 2021. It is pretty much in line with these risks, with crypto deliver 705% return. Even if we do 2 years back, if you think 2020 has been a really bull run for the stock market, its annualized return is still the highest, with the value tripled with the original cost of the investment. If you had $10,000 or even $1,000, how would you invest? Are you happy with your current asset allocation? Please leave your comment below. My name's Irene. I'll see you next week. Bye.